In November, I told you the system was broken. My old spreadsheet was blind to growth, leading me to value traps while the world moved forward. I spent that month rebuilding, not just a tool, but my entire approach. December wasn't just another month of investing, it was the first flight of a new machine. The stakes couldn't have been higher. December is usually when the Santa Claus rally carries everyone, but this year the market was tired. The S&P 500 stumbled, ending the month down minus 0.05%. But for the first time this quarter, my portfolio didn't just keep up with the giant, it outpaced it, finishing the month at 0.91%. I plugged the numbers in, and the machine spoke a new language. It didn't point to the usual suspects, it identified titans my old system would have simply ignored. NVDA, Amazon, Microsoft. It was telling me to lean into growth, but with a safety net. The strategy shifted into the intrinsic value calculation. By using a 20% margin of safety based on my total average cost of a company, I created a shield. It worked. While Dell and AMZN took hits, the growth picks like NVIDIA helped anchor the month. But it wasn't all green. Aurora Calibration Corporation dropped nearly 9%, AMZN and Dell were also down. The winners, they were thunderous. Omnicom Group surged 13.5%, Rio Tinto Group up over 10%, and NVIDIA up 6.68%. This diversification I've been preaching for the year finally caught wind. I followed the machine, I didn't second guess it. I deployed $534 to the year-end volatility. I picked shares in the Titans, NVIDIA, Amazon, Microsoft and Bank of New York, while I bolstered my foundation with Realty Income and Dell. Even with the tech high growth, I kept my feet on the ground. 5% went to the gold ETF and 5% went to Bitcoin, 20,000 Satoshis and 0.06 shares of the gold ETF. In this house, we don't chase hype, we build brick by brick. And then the gifts. 8 companies sent me their thanks this December. $12.03 in passive income. To some, that's a cup of coffee. To me, it's proof that this machine is working. From Microsoft to Visa to the dividend royalty like Coca-Cola and United Health Group, the money flowed in. No matter how the market prices fluctuate, the dividend is the heartbeat. It's the only part of the market that doesn't lie to you. 1 year ago, I set a goal to hit $7,426. Today, my portfolio stands at $7,891. I didn't just meet the milestone, I smashed it. But there's one number that stands above all others, and that number proves that this isn't just luck. This year, the S&P 500 was a powerhouse, gaining nearly 18%. Most investors would be thrilled with that. But my portfolio, my Dividend Dad strategy, finished the year with a total gain of 26.86%. I beat the market by nearly 9%. I nearly doubled my own annual target of 14%. Year 1 is in the books. The machine is calibrated, but as we head into 2026, the question changes. Can I keep this lead? Will the new spreadsheet hold up when the next Black Swan event hits the market? Join the journey. 68% of you watch these updates, but you haven't subscribed. If you want to see if a regular dad can keep up with the Wall Street giants in 2026, hit that button. Like this video if you're building your own legacy, and tell me in the comments, what was your final gains for 2025? The climb to $100,000 has only just begun.